Today we'll be speaking about the advanced techniques for gold investors, how we can trade gold. At any point, if you can't hear my voice or you can't see my screen, please send me on the chat, so I will try to fix the issue. Okay, we will start by defining this thing that we want to trade. What is gold? Okay, maybe for some of you this might be like a very simple question, but maybe before we start trading this commodity, we need to understand what is the reality of this. So gold is a precious metal. It's yellow. It's highly valued since the ancient times. We think that the oldest gold piece we have already is from Egypt, from ancient Egyptian civilization. But across history, gold was always have its present in as a jewelry, as a use, as a symbol of wealth. So for someone who doesn't know, gold would be just a shiny yellow metal, but it has been valuable for thousands of years. So actually, chemically, it doesn't rust, and it's rare. You cannot find it. It's not like sand. Sand you can find anywhere, but gold is rare. So because it's rare and it's doesn't rust and it's shiny, people like the look of it and use it as a symbol of the wealth. So this is gold. This is the ancient Egyptian king Tutankhamun. So this is the famous mask. Of course, you have seen this before. Actually, one of the reasons that we found this mask is that this stamp it was not discovered by the thieves. So it was gold. Everything was gold, and the pharaoh kings used to have all of this golden symbols and masks, but of course it was stolen. But this Tutankhamun mask is very famous because its beauty and its symbol of the Egyptian civilization, and it's from gold. Greek and Romans also revered gold, using it as a currency to display wealth, and also it was a currency in a day-to-day trading or use. Until the 19th century, the gold wasn't the standard monetary system, but at this time it was, and then nations accumulated gold to reverse their currency. So each dollar or each currency was backed up by gold. This was until 1931, when Britain left the gold standard, and then followed by the US in the 1971. The United States abandoned the gold standard, and since then, no currency, no actual currency that we use today is backed by gold with the standard gold standard. But until now, still people retain the value and the symbol of gold as something of value. So we use gold actually in some industrial application. So it's not only jewelry, it's not only that we like it, but actually we use it in the advanced technology like phones and like laptops. There is some gold in it. Okay, now you'll start like opening your phone, trying to find some gold and sell it. Actually, the actual amount of pure gold is very little, but it's there. So in this industries and this technology, gold is actually usable and very important. So from this, we will summarize that the gold has some historical anchor from ancient history. We know that our grandfathers valued gold, and it was a symbol of wealth. And until very recent, it was a currency we use, or backing up the fiat currency. Fiat currency is the paper money, so it was backing up by gold. Until like very recent, the 70s, it was backing up by gold. Then the gold standard was removed. Of course, until now, it's still a safe haven. When we say safe haven, that means that something you try to keep your wealth in, to save it from inflation or from other risk. So it's still a safe haven until now. It's still a commodity. It's still something we buy and sell to use, either in jewelry or in the industrial use. Okay, so now after we know all this about gold, as I mentioned, if there is any, you can't see my screen or you can't hear my voice at any moment, please send me on the chat. So okay, looks like everything is working fine. Let's move on. So now we want to trade gold. How we can trade it? How we can? I like this metal, this yellow shiny metal, and I want to buy it. How I can buy it? There is more than one option. The first option, what we call the spot trading. Simply, spot trading is like when you go to a store and we have money equal to the amount you want to buy. You give the money, you receive the gold at the same amount. This is immediate transaction. We call it the spot trading. So you are buying and someone else is selling actually in the same time with a price you both agree on. Okay, this is like any other commodity. So I explain it. It's simple, but I explain it because there is other ways of buying gold that I will explain later if someone is new to this. So there is a market price for gold. So it's like it's not like you go to the store and he say, for example, the gold price now is 2,700, and say, no, it's very expensive. I will leave. So he will go, okay, I will decrease the price for you. He can't. The actual pure gold price, because there is of course other charges for if it's a jewelry or if something else, there is other charges, but the actual pure gold price is something we all see on the screen of the foreign exchange market. I will show you after a moment. So this gold, pure gold price, is something that go up and down based on the market transaction and the liquidity, but we all use the same screen. To even when you go to your local store, is using the same screen. I'll show you in some time. Okay, this is the first we call the spot, or the immediate buying of the actual gold. There is something else that we call the future contracts. A future contract, actually you can buy anything in a future contract. We had a webinar maybe 3 months about futures. Quickly, futures is something you are willing to buy, you are willing to get, but not now. You don't want to receive it right now. You remember the first thing, the spot is I'm paying for the gold, I want to receive it right now. For the future, you are paying, but you are not willing to receive it right now. There is some date in the future that you are willing to get this gold you want to buy in. This amount of time will depend. It might be 1 month, might be 3 months, but you are not willing to receive it now. Okay, this is the what we call a future, and with that, the company or the provider of this service can give you something else that we call leverage. In the first way or method of buying gold, the spot gold, you are buying as much money as you have in your pocket, okay, or in your card. But at the future contract, there is something called leverage. That means you have a purchase power equal to your money multiplied by the leverage number. So for example, if the service provider, if the brokerage giving you 100 time leverage, means each dollar you have a purchase power, buying power of $100. So if you have $1,000 in your account, you can buy gold worth of $100,000. This is what we call leverage. So to do this, there is some standard weight that we call ounce. So you cannot use these futures like I want to buy like 1 gram. No, there is a standard weight, which is the ounce. The ounce of gold is 31.1 of the 24 gold carat. Let me show you the screen, please. If you can't see my screen, or if you have any issue, please. Oh, okay. I think you can see the chart. Let me just change something here. Okay, you should now be seeing the MT4. Okay, please tell me if you can't see it. Okay, looks like it's working fine. So this what you see right now is the actual gold prices that's moving while we are speaking right now. Okay, it's the price is $2,730 per ounce. This is the actual price of ounce. So the ounce equal 31.1 gram of 24 carats. So if you want to know the price of gold, actually the local store in your country do the same. He look to the screen, he divide the number he see by 31.1. This will give you the 1 gram of gold of 24 karat. The price will be $87.78. This is the 1 gram. Okay, if you want to buy the something else like 21 carat, you will multiply this number by 21 and then divide it by 24. This will give you 76. So the screen you are seeing right now is showing that 24 carat. The weight of the ounce is 31.1 grams. So if you want to know the 1 gram price, you will divide the number you see on the screen by 31.1. This will give you the 24 gram. And if you want other, you will multiply it by this like 21. So you will divide multiply it by 21, then divide it by 24. Okay. This is how the actual gold price in your local store are calculated. So if you are now willing to trade the gold not as a spot, not as a future to be delivered after some months, you are willing to just trade it to make profit in a very fast moving market like a scalping. Okay, scalping is anything starting from even 1 minute or even less. If you have the ability to do so, you can trade, buy and sell the gold, buy and finish the trade. Let me give you an example. We can now, let's say that for some reason we want to buy gold. So we can just buy, this is the trade, and then it moves for some time and we close it. It happened just in a minute. Okay, you can't do this in the spot, you can't do this in the actual gold market. Okay, but I think the reason everyone here is coming for to know or to learn is how I do this, why I buy or sell at a certain time or a certain price. This is as they call the $1 million question. Okay, everybody is asking the same question. And the answer is a combination of a lot of things that we already spoke about. We spoke about technical analysis, we spoke about fundamental analysis, we spoke about news, trading, and the economic events. And there is one more thing, which is the geopolitical events. So if you want to trade the gold, you start by knowing that first thing, you know that you are trading gold against US dollar. This is the first thing you know. So the chart you are seeing right now, it's not gold by itself, it's gold against the US dollar. This is the global market price. It's gold against US dollar. You will see here XAU, which is the chemical symbol for gold, against the USD, which is the symbol for the United States dollars. So XAU USD, this is the pair you are trading. Whenever the application you are using, you will look for XAU USD, or simply just put gold on it. So this is the first thing you will need to know. Second, in your plan, you need to simply identify that trend. Okay, a trend is a series of higher highs or higher lows. This would be an uptrend, or a series of lower highs and lower lows. This is a downtrend. So if you look to this 1 hour chart, let me make it. What do you think? What is the trend? I think, yeah, most of you said it's an uptrend. Okay, it's a clear uptrend. Okay, but what if it's not clear? How you can define the trend? You can insert, this is the MT4, go to the insert indicator and then look for the trend, then moving average. You can use anything from 200 till 7, anything. Okay, let's keep it 21. This is the 21 moving average of the 1 hour chart. Okay, let me add another one, which is the 200 moving average. Let me change the color so you know the difference. See, so both the 21, just a quick note, when a price is above the moving average, this is an uptrend. When it's downward, it's below the moving average, it's a downtrend. Okay, so both the 200, which is very high moving average, and 21, which is like a low moving average, not very low, but it's a low moving average. They both giving us now indication that we are in an uptrend. Okay, but now the 21 actually is being touched by the price. So the price actually yesterday broke it. It was down. So the first thing you need to do is what I'm doing right now, which we call the trend identifying. To identify the trend, to know where are you now. So you use the moving average to do so. 200 moving average, 21. Let me add one more, which is the 50 moving average. This will be good also to give us middle ground. Okay, let me make it blue. Yeah. So now you know that the moving average of the 50 days is actually broken. So down the price is in a downtrend according to the 50. So now we know how we identify that trend. This is the second thing you do in your trading. So the third thing you can use is technical indicators. There is a lot of technical indicators, and I have spoken about a lot of them, but just to use today, we will use something we call RSI, the Relative Strength Index. RSI is very important to give you an indication of the overbuying and overselling zones, but I think there is other use you can make benefit from is to give you an indication of the trend as well, because most people use it like 70 and 20. When it's in the 70 zone, this is an overbought, and the 20 or 30, it's an oversold. But actually, I can give you extra hint, which is the 50. If the price is above the 50 of the RSI, we are still in an uptrend, and sometimes the 70, the price will stay there for some time. So from 50, I'm willing to buy. It's like it's above the moving average, so it's above the 50 of the RSI, so I'm buying. It's below, so I'm selling. If it's making like in the 50 itself, still didn't decide, I will wait until it break either up or down. So this is something I can use. There is also the MACD, but I don't want to waste more time because it's giving the same idea. It's trying to get the momentum of the price move. Also, you can use Fibonacci. I have already made a webinar about Fibonacci, so you can use it also. So this is the third thing. Use a technical indicator to go to your trade. And then after you make this technical indicator, you see or analyze the candlestick pattern. This is the fourth thing you do. Also, I have spoken about candlestick pattern. You see, I told you that what you are going to do with gold is a combination of a lot of things. We spoke about technical analysis. We spoke about moving average. We spoke about candlestick patterns. You will use all this to understand the trend, to understand the over buying and overselling and momentum of the market and the candlestick. Let's continue with the candlestick pattern here. See this pattern here. I like it's a hammer, you know. It's after a very strong move down, and this hammer. So after this, you expect the market will go up. You can buy from here and put your stop loss below the tail. Actually, the market went down for some time, but the stop loss would be below this tail of the candle, so it should now be still in a very good up trend after this candle. Now it's going down for some time, but still it's above the price of the open of this one. So this is like a candlestick. There is also a lot. You can see this pattern here. It's a reversal pattern. Okay, you know this. So this was also here. When you have this, okay, forget about the names. You have a red candle and a very small candle between, then a big green candle that's almost the same as the open price of this. You now have this pattern, and then you know the market will go up. This is the reverse of it. The market will go down because there's this green candle, one in between, the red candle actually going to the same open price, so the market will go down. And this doji is like indecision, so it supports that the market will continue in the same pattern. 1 2 3, this is the three soldiers, if you remember. Forget about the names. 1 2 3 candles in the same direction in very big bodies, so you expect the market will go in the same direction for a big move. And actually one candle after this was very red, and that was a candlestick pattern you can use. So after you do this, you set your entry and exit point. We already did this. So for example, if you are now seeing, let's see this candle, you are seeing the RSI, which is giving a momentum not going to the 30. This is not the reason. It's going up from the 30. Now I have a momentum going up, and I have a candlestick. This one, I would go in this trade. For some time it's losing, but I would put my stop loss here below this candle. So my entry will be here, my stop loss will be here. I would put my take profit below this support level, because it will probably will be a resistance next time. And actually that would happen. The price move up a little bit, but I'm not greedy. I'll be okay with this kind of profit. So this is the fifth thing you do. You will use or set your entry and exit point. And the most important thing, the number 6, is the risk management. This is why most traders fail in trading gold, because they don't use risk management. I know the market will go up, I will buy now, I'll get all the profit, I will double my account. This is the typical story that happened before you blow your account. Okay, even if you know what's the direction of the market, even if you have, remember that everything you know is not a science, it's an art, it's a technique to predict the market, but you don't know for sure, for 100%, where the market will go. So you have to manage the risk. You have to have a stop loss, simply a place where you know that I will not be in the market after this point. I will just leave. Okay, so the stop loss is very important. and it will protect you from blowing off your account. So for example, at this trade, I will put my stop loss below this. So even if the trade is not in my favor, but I would end it when it's here. So I will not go against the market. And the number 7, you monitor and adjust. What I mean by that is, okay, sometimes you put your stop loss here, okay, at the tail of this candle. Okay, let me. Okay, so here sometimes the market actually touch the price, but then go up again. So you remember this, you adjust your plan that I will not put it exactly at the tail of the candle, but below this price, a little bit below it. So you learn this from the actual live trading, and also you see this, like if you put your target here, you see the price actually it was touching this and then went down. So if you are not greedy, you would go out of the trade at this moment. You wouldn't wait for all of this moving against you. So you will learn from the market to be, generous with the market sometime. So you give some points because you don't want to wait more, okay? And you offer the market more in your stop loss, but keep the one-to-one, at least one-to-one risk to reward ratio. So you adjust this. Sometimes you can make it 1 to 2, at least 1 to 1, I recommend. So now we have some time for your questions. So I'm waiting for your questions. If someone already sent me a question, I will answer. I will address all your questions right now. Okay, if I'm in the market right now, what I would do? Okay, I would do exactly what we were just speaking about. First, I will identify the trend. Actually, now the trend is not clear uptrend. Now, in this very moment, if I'm just opening the chart now, I didn't trade for months, and I came now, open the chart, it's not a clear uptrend. It's up, but it's not a clear uptrend because of this very strong move in the down, breaking the moving averages. So this will not be the exact uptrend I'm looking for. Okay, it's above the 200 moving average, but my stop loss would be very, it should be below the moving average. If I'm using a moving average, I should have my stop loss below this moving average. So if I'm using the 200, it would be around 2,700. Okay, if you are willing to put your stop loss below this, you would buy uh, according to the 200 moving average. But I would wait for some time for some confirmation, because the very strong move yesterday and today would make me just wait a little bit. Just I will wait, or I can move to a lower time frame. This is a 1 hour, okay? This is the 4 hours, okay? And this is the 15 minutes. See here, actually the price is below all the moving averages. So now, according to the 15 minutes, this is a downtrend. What's the difference? The difference is, if you are analyzing on the 15 minutes, you will be having short-term trades. I will not open a trade in a 15 minutes and leave it for weeks. Okay, I want to have my target as soon as I can. It should be like 4 to 5 candles should give me the target I'm expecting. So if I'm using, I don't think, okay, 5 minutes, okay, I'll go with you. It's the same. It's a downtrend. It's breaking the moving average. I should sell. I should put my stop loss above the moving average. But actually, I wouldn't do this, because see, this is the 1 day chart. We are in a very strong uptrend. Even if you are willing to trade in the 1 minute chart, even if, you need to be aware of the big trend, the longer term trend. So even if you are, let's go to even the 1 minute chart, All of this is not recommendation. You can always keep your decision based on your knowledge. I'm just uh, if you are willing to trade in a 1 minute chart, I wouldn't recommend this. But if you are willing to do so, you need to be aware of the 1 day chart, the daily chart. You know where the market is going. Then you go to the 1 minute chart. Okay. Now I would even, if I'm going to sell, I know the market is going in an uptrend, but now there is a down move, very strong down move. Maybe it's a consolidation. I would use this for my favor. So I would do this. But actually, I will not buy or sell in a 1 minute chart. So let's go to a 5 minute chart. Okay. You can see here the move was, if I'm in your place, I would see the move up was very slow and the move down was very fast. Actually, this gave me an indication that the stronger is the bulls, the buyers. Why? Because when the market moves very slow, means there is actual buying and selling going in the market, driving the price to where it's going. I don't care if it's up or down. If it's going very slow, making new highs, this is a very strong move. If it's going down very fast, this is fear or profit taking, or some orders was in a price and it's now collapsing because this order was like in the same time, but the actual trend is still moving up. So I may benefit from a down move. Yes, I may. So now I can sell and put my stop loss here, but I still don't want to be against the actual 1 day trend. This is the way I would do it. Okay, maybe I'm so classical, but I don't like to trade against the trend. Okay, I know the trend can reverse, and I know the consolidation of can be very strong. Yesterday only the dollar went like $50 down. Okay, this is a very strong move. Someone can make a very good profit from it. Now, while we are speaking, the from the high of today, which was around 43, the gold was down until now around $20. This is very strong move, but still I can see opportunities, or I would look for opportunities to buy, not to sell. So even if I'm in a 5 minute chart, I will buy. Like now, I will buy. I'll put my stop loss if I'm in a very strong move like this below. So let's say 17 to 717. Okay, and I would make my target around the 2740. So this would be my trade. There you go. What do you know? We already $1.50 winning while we speak. Okay, this is not okay. What's happening right now? I'm not a magician. I'm not making magic. Okay, it happens. Sometime it happens. Sometime the market go favor what you do, but don't expect this to happen with me or with you all the time. Okay, sometimes the actual opposite happen. Okay, again, I repeat, when you see me do this, don't think I have any kind of magic power. This is normal. This is just as what would you do if you use the knowledge I gave you today. Okay, identify the trend, but the only difference is I wouldn't pick signs of selling against the prevail trend in the higher time frame. This is the only thing I wouldn't do. Okay, so based on this, if the market is giving me selling opportunities on the 5 minute chart, I wouldn't take it. Okay, I would only look for this opportunity to buy. Okay, something else you can do, some people do, when you have something like this, you can move your stop loss to your entry. So this is what we call the risk free, or you can be a little greedy, so you keep your reverse like $1 extra. So yeah, so now even if the market go down again, I wouldn't lose. Actually, I would win a little bit. Okay, sometimes we will use something else like closing half of the position like this. I already have one, so from this one I would close half of it. Oh, so now I have $170 already reversed, and I would not lose anything in this trade. Actually, I would win the 170 I already reserved, and the $2 that I reserved with the stop loss. This is what I would do now. Again, what just happened right now, it was, I would not say luck, but I would say when you get lucky when you do your homework. Okay, sometimes you get lucky when you do your homework, when you do your job, you try to put your stop loss, you try to find the good trade. Sometimes you get lucky and sometimes you don't, so you always keep in mind when you are opening the trade that this one might be not very lucky. You still didn't know, so you keep your risk management, you keep your stop loss, and this is what I would do. If you already entered the trade with me, okay, good luck. Buy me something for with the profit. Okay. So if there anything else, you always do these webinars at Thursdays, 6 p.m. Dubai time. Please join us in the upcoming webinars. And this is for free, of course. We always try to provide you with insights and information about market. So if there is no more question, I would end this session. You will also receive an email after this. You will have my contact information. You can WhatsApp me. You can send me any question you have if you didn't have the time to send me right now. And I will be more than happy to communicate with you. So it seems like everything is set, and we will now be ending this. Thank you for your time. I hope that you enjoyed and get some benefit and insights from this webinar. This is Islam Ahmed, and I will be ending this session now. Thank you and goodbye.